Hi everyone, my name is Ramana Reddy and I am a tax lawyer from Hyderabad. Today I wanted to talk to you about a fundamental feature underlying the GST regime. And that fundamental feature is called the input tax credit. Now, this is literally the backbone of the GST regime, and the entire system literally works on input tax credit. And it is a huge part of the GST regime. Some of my lawyer friends have asked me what that means, so I thought I'd make a quick video about it. The goal of the video is not to make you an expert in understanding the input tax credit regime. It is only to give you a layman's understanding of what input tax credit means. And so that is the goal of the video. Now, before we understand what input tax credit means, it is important to understand the distinction between a direct tax and an indirect tax. Now, GST is an indirect tax. Income tax is a direct tax. So what's the difference, right? So at the end of every financial year, you go to your chartered accountant, you sit with him or you sit with her, and you pay your tax to the government. Now, when you do that, you pay directly to the government. So money is debited from your account, and that money is deposited into the account of the government. But on the other hand, let's say you go to a supermarket and you go to buy a pencil. Now let's assume that the price of the pencil is 10 rupees. So when you go to buy a pencil of 10 rupees, the owner of the supermarket will charge you 10 rupees plus he will charge you 2 rupees, for example, as tax. So if you see the invoice that is issued to you by the supermarket, you get a bill for 10 rupees plus 2 rupees as tax. So therefore, the total bill that you pay will be for a sum of 12 rupees. Now, in this particular case, although you're paying 2 rupees as tax, you're not directly depositing the money with the government. You are depositing the money with the owner of the shop, and he in turn deposits the money with the government. So therefore, this is an indirect tax system. Unlike GST, where you direct, I mean, I'm sorry, unlike income tax, where you directly pay the amount with the government, under the GST regime or under any indirect tax regime, you deposit the money with a shopkeeper, and the shopkeeper in turn deposits the money with the government. Now, there's another thing that you need to understand before we get into the nitty-gritties of what an input tax credit means. It is important to understand that, let's back up. It's important to understand the meaning of a supply chain to begin with. So, take the example of a car manufacturer. Now, to make a car, there are a lot of parts that are involved. He needs the batteries, he needs the windows, he needs the engine, he needs the carburetor, and he needs, whatever else is needed to make a car. Now, he has to procure all these things from people in the supply chain who come before him. So take, for example, the simple case of a vehicle body manufacturer. So if somebody is manufacturing with the body of the vehicle, and suppose the car manufacturer outsources that kind of activity. So let's say I manufacture the body of Hyundai Creta. So I specialize in the manufacturing of the body of Hyundai Creta. And I buy some steel, I manufacture the body, and then I turn around and I sell it to Hyundai so that they can use that in the car. Now, so we have a three-step process. You have the steel manufacturer, you have the vehicle body manufacturer, and you have the car manufacturer. Now, it is important to understand that GST, or the indirect tax system as it currently is, it only taxes a value addition. So what does that mean, right? So for example, steel, that is just pure raw material. Now, as the vehicle body manufacturer, I take the steel and I add value to it. So that basically means I create the body of the vehicle. So I have added value to the steel that was just raw material. And then in turn, when I sell it to the car manufacturer once again adds value to the body of the vehicle that I gave to him. So at every stage, there is value addition to the product itself. Or to take another simple example, I have a shirt. Let's say, for example, I am a tailor. Now I buy raw material, which I just buy cloth, and I get the cloth. Now that is like the steel. I just get the cloth. Then I come and I make the shirt. I stitch the shirt. Now in that particular case, I add value to the piece of cloth that was just given to me. So it is important to understand that GST taxes only value additions. It does not tax the entire amount. Now, what does that mean? Once we get into an example, these things will get much more clearer. So let's jump to my screen right now, and I'm going to show you a specific example as to how input tax credit works. This is the best example that I've come across, but if you find simpler ones, feel free to use them. But just to understand the concept, here's an example I have for you. So let's jump to my screen right now. Hey, welcome back. So this is a chart that I've prepared to help you understand what input tax credit means. Now, do not get confused. We will go step by step. Uh, so again, just don't be confused. So here is a change. So if you remember, we talked about an example where I am the vehicle body manufacturer. So I procure steel from, a raw material supplier. I turn around, I manufacture the steel, the body of the vehicle, and once the body of the vehicle is manufactured, I then sell that body to the car manufacturer. So in the example that we took previously, I was manufacturing the vehicle body of the Hyundai Creta, and I sold that vehicle body to the car manufacturer. So here is the same case here. So let's take the example of B. Let's just go with B because B stands for Batman, and I'm a huge fan. So let's go with B. Now B here is the vehicle body manufacturer. Now, as we discussed, he needs to procure steel to manufacture the vehicle. So what he does is he goes to A, and A is the steel manufacturer. And he says, hey, A, can you sell me some steel? And A says, sure, I'd love to sell you some steel. And so A asks him, okay, how much? What is the value of the steel that you want for? Well, B says, well, I can afford about 150, or steel worth rupees 150 right now. So just give me steel worth 150. So A tells him, okay, I'll give you steel worth 150 rupees, but I have to add tax, and only then can I sell you. Again, remember, just like the pencil, where we had gone to the supermarket and we had paid 2 rupees in addition to 10 rupees, but the bill was 12 rupees. Similarly, here, B would have to pay 150 rupees for the steel, as you can see here, and 27 rupees as tax. So totally A would, so B would pay a sum of rupees 177 for the steel. Now B gets the steel to his warehouse and he gets to work. He takes the steel and he manufactures the body of the vehicle. Now, when he manufactures the body of the vehicle, he has added value because the steel is just raw material, just like cloth that a tailor takes and he makes a shirt out of it, thereby adding value. Similarly, our vehicle body manufacturer takes just takes the raw steel and he adds value by making a vehicle body out of that steel. So therefore, the price goes up because this is a better product than just having steel. So now B would like to charge 200 rupees. And in addition to 200 rupees, he has to charge 56 rupees if he wants to sell the vehicle body to a car manufacturer. So let's say at this stage, now that the body of the vehicle is ready, B is ready to sell it to the car manufacturer. Going with that example, because he manufactures the vehicle body of the car Hyundai Creta. Now he wants to turn around and sell it to Hyundai so that they can, add the tires, the batteries, and so on, and all these things that go with a car. So now when B wants to sell to C, what does he do? So he tells C, hey, C, look, you want to buy? Okay, I'm willing to sell it to you for 200 rupees because I've added value. Although I purchased the steel for 150 rupees, I can sell it to you for 200 because I've added value. And in addition to 200 rupees, I will have to charge you tax of 56 rupees because remember, just like the pencil, there is tax that has to be paid. So I will have to charge you a total amount of rupees 256. So now here, if we just look at B, now here B has paid 150 rupees plus 27 rupees as tax for his inputs. Now he turns around and he wants to sell his outputs, that is the vehicle body, for 200 rupees with a tax of 56 rupees. Now when B sells it to C or when B sells it to Hyundai, he collects 256 rupees. Now the question, at least the interesting question is, when B collects 56 rupees as tax from C as GST, does B have to deposit the entire 56 rupees with the government? Because I mean, if you put yourself in the shoes of Hyundai, Hyundai will say, look, boss, I paid you 56 rupees not for you to pocket that money. I paid you 56 rupees as tax. So, what you should logically be doing, because you collected that money as tax, you should deposit that money with the government and not take a single rupee out of that 56 rupees and put it in your pocket. If you do, then I'm going to report you. Now, C would be right. I mean, that argument makes sense. How can you collect something as tax and just put it in your pocket? Now, C would be right, but for the concept of input tax credit. Now, if you look at B here, he has paid 27 rupees as tax to the steel manufacturer. And this is because he had to purchase his inputs. Now, I want you to think of these 27 rupees as points. These are basically points that B has accumulated when he went out to purchase his inputs, that is steel. Now when he turns around and he sells the vehicle body to C or to Hyundai and he collects 56 rupees, now he, logically speaking, he would have to deposit 56 rupees with the government. But, but, he has 27 rupees as points in his account. And what he is entitled to do is he can reduce his liability of 56 rupees with 27 rupees, and he can pay to the government a net liability of 29 rupees. Now, if we think about, well, why does the government even allow this? Uh, because has he not collected 56 rupees from Hyundai? So why should he deposit only 29 rupees? I mean, why should he be given credit of 27 rupees? And why should he be allowed to deposit only 29 rupees? Now, this is coming back to what I was saying earlier. The reason behind this, or the reason behind giving B the option to deduct points that he's accumulated, is that tax is only charged on the value addition. It is not charged on the entire sum. So, he has now B has added about say 50 rupees of the of value to the steel because he bought it for 150, he's selling it for 200, so he's added value of 50 rupees. Now under the indirect tax system as it is today, what B has to do is only pay tax on the extent of the value addition. And one way to arrive at the value addition is to subtract the tax that he has already paid to his supplier for his inputs. So therefore, in this case, since B has 27 points in his account, he is liable to pay only 29 rupees. Now these points are also called as the input tax credit, which he already has in his account, which basically means that he will be given a credit of 27 rupees, or he will be allowed to set off 27 rupees to arrive at his liability. Now, moving on, just to take this example one step further, now B sells the body of the vehicle for 256 rupees to the car manufacturer. So Hyundai purchases it. Now, for Hyundai, the vehicle body is the input, whereas for the vehicle body manufacturer, the vehicle body was the output. Now, for Hyundai, that the vehicle body is his input. So he has paid 200 rupees towards the vehicle body and 56 rupees towards tax. Now, once the vehicle body is in his factory, is in Hyundai's factory, he adds all the gizmos that go into the car. He adds, the engine, he adds the glass, he adds the battery, he adds the tires, and he adds, all these things. And he basically adds value to the vehicle body. And under GST, the car manufacturer or Hyundai is to only pay tax on that value addition. Now, how does that work? It works the exact same way as it worked for the vehicle body manufacturer. So, how it will work for the vehicle body for I'm sorry. So, how it will work for the car manufacturer would be, now, the car manufacturer manufactures the car, he turns around and he sells the car to the ultimate consumer. So when, let's say, I go to buy a Hyundai Creta, so what I pay to Hyundai is I pay 300 rupees for the car and I pay 84 rupees as tax to Hyundai. Now, in this particular case, Hyundai has accumulated points of 56 rupees already because he has paid 56 rupees to the vehicle body manufacturer. So 56 rupees are points that he already has. And Hyundai has collected 84 rupees from me when I go to buy the car. Now, does Hyundai does it has to deposit 84 rupees to the government? No, because although it has collected 84 rupees as tax, it already has 56 rupees as points. So therefore, all it is entitled to deduct 56 rupees from 84 and pay a tax of 28 rupees. So, put another way, input tax credit is a way for businesses to reduce their tax bill. It is a way for them to reduce their tax liability. And there's no surprise, but this is the reason why there is a huge amount of litigation surrounding input tax credit, because the government receives less money if, as a business, it is it sets off its liability. Now, generally speaking, input tax credit is allowed, but GST places many conditions on the availment of input tax credit. So, therefore, there is a lot of litigation surrounding input tax credit, and well, that was the basic intro to the input tax credit system. I hope that was helpful. And if you have any love mail or hate mail, or any questions or comments, please feel free to put them in the comments. I don't, although I may not respond to each one, I definitely read all of them. So thank you for watching.